Assalamu alaikum. Welcome to lecture 16 of ATX. Lecture 16 is a new fresh topic, that is trust. So till lecture 15 I have finished inheritance tax. So now let me summarize up to now what I've covered. I have covered income tax, capital gain tax and inheritance tax. So three type of tax are covered. Now we are moving on to trust, and trust is just this one lecture. After that, we'll be moving on to corporation tax, that is company tax. So we are left with corporation tax, VAT, and ethics. So very few lectures are left. We have covered you can say 50% of the syllabus is covered. So please go back and watch those lectures and do revision key questions. But taxation of trust is a mixture of three type of tax. It has an impact on all your three previous tax that you have studied, that is income tax, capital gain tax and inheritance tax. That's why I've covered those three first, and then I've thought of doing with trust. And trust, mostly you don't have to calculate, it's just that you have to know few things. Okay, wherever the things that you have to study for your exam will be told in this lecture. So let's start. Here we are going to focus on the nature of the trust. Very important is the nature of the trust. Based on that only you will be taxed, how you will be taxed. Types of trust: income tax and trust, capital taxes and trust, tax planning opportunities, and summary. Very important. You should be able to do tax planning with trust as well. As I told you, tax planning questions pops out in any topic, whether income tax, CGT, corporation, VAT, inheritance, even in trust. Okay, so we are going to go through the definition of trust, the types of trust, then tax and financial planning, tax implications. That is, one side we have income tax, it is just income tax, and capital taxes. Capital taxes are, there are two capital taxes. One is your capital gain tax, CGT, and the one is IST, inheritance tax. You should know taxes are two types. One is revenue tax, the other one is capital tax. Revenue tax is your income tax, and capital taxes, which are capital in nature, are your CGT and inheritance tax. That's why they're not just CGT. Inheritance tax is also a capital tax. So do not get confused with CGT and capital taxes. Both IST and CGT comes under capital taxes. So the question tells you impact of capital taxes, mean they are asking you the impact of IST and CGT, and this is normally the situation. Capital taxes when assets are put into the trust, capital taxes when assets pass to the beneficiaries. Okay. Now let us revise how a trust works. What is a trust? Let us start with very basic before we move on to the more advanced thing in ATX. This is the place where we are started in tax. Okay, so don't worry if you forgot how trust works, what is the nature of trust. Don't, it's okay. We are going to revise it again here. Okay, and trust you have come across in tax as well, but there not so much in depth. Okay, we didn't study the impact of IST, CGT, income tax there so much. Now, a trust is an arrangement where a property, okay, it could be known as trust assets or settled property, is transferred by a person known as settler to trustees for the benefit of one or more person, specified person, and those specified person for whom the benefit, for whom the trust is known as beneficiaries. Beneficiaries, it could be one beneficiary or two or more, and it is held by trustees on specified terms in the trust deed. If all these things are there, the arrangement is known as trust. Okay, so through a diagram, if I have to explain you, from the settler the property passes into the trust. So it is the settler's property, they put the property into the trust, and the trustees are given the legal title to the property. So the income from that property passes to the income beneficiaries, and the capital is distributed to the capital beneficiaries. Okay, now the financial planning benefits. What is the benefit of trust arrangement? Why would a settler wants to give their property in the trust rather than keeping it in his own hand? One reason is to provide an income from the assets for one group of beneficiaries while preserving and protecting the capital for others. You might have two, three. Let's say you have three sons and two daughters. You might want to give the income to your daughters or capital to your son. So if the settler has the property, it's very difficult to do that. Everyone will be fighting with each other. Everyone wants the asset. Everyone wants the income. It's very difficult to divide like that, right? But if it goes through the trust, okay, trust will decide whom to which group of beneficiaries asset will go to which the capital go. It's like a protection. You can preserve it in the trust. Next, second advantage is through this way the older generation could protect the financial provision for the next generation. Okay, let's say you want to protect some asset for your children or grandchildren. Trust is advantages. Next, third, transfer the benefit of owning the property to minor. Yes, properties will be owned by the minor, but the control over the asset, even the responsibility of managing and maintaining the property, is with the trustee. Now, there are two main types of trust that are going to be asked in ATX. This is very important now. First one, discretionary trust. The next one, IIP. IIP, interest in possession trust, also known as life interest trust. Okay, you could be given any one of it. First, we'll go through discretionary trust. The discretionary trust is a very flexible settlement where the beneficiaries have no legal right to benefit from the income or capital of the trust. Beneficiaries, they don't have the legal right to the benefit from the income or the capital. Here, how the capital or the income out of the trust will be distributed is totally in the hands of the trustees. It is in the complete discretion of the trustees. Trustees will decide how they want to give, to whom they want to give, and when they want to give. That is discretion. That hence the word discretionary. Okay, power lies in the hands of the trustee, not the beneficiaries. Therefore, the trustees can determine how to meet the needs of the beneficiaries as and when they arise. Okay, now that means trustees have the power to decide whether or not the trust income is to be accumulated or distributed, how the trust assets are managed and invested to generate income and capital growth, how the trust income and the capital of the trust is to be shared among different beneficiaries. Now let us do one question to see the nature of discretionary trust before we move on to IIP trust. What is the difference in the IIP trust? Illustration 1. So illustration 1 is an example of discretionary trust. Okay, this is a trust which is set up. So the settler is Imran, trustees is Imran and Khalid. Khalid is Imran's son. Beneficiaries is Imran's grandchildren. The trust property, that is 200,000 shares in ABPLC. So now what is the income and what is the capital? So now the income can be accumulated for up to 20 years from the date of trust settlement. Now, subject to the trustee's power, this is the main thing in discretionary trust. Subject to the trustee's power, the trustees shall each financial year distribute the income to the beneficiaries and come into the capital. Trustees may advance the capital of the trust to beneficiary at any time and shall have an absolute discretion as to the proportion of the capital of the trust to be distributed to any such beneficiary. Okay. IIP trust. In this trust, beneficiary has an interest in the assets of the trust. So an IEP can be the legal right to receive income generated by the trust assets, to use a trust asset or live in the property owned by the trust. So what is the difference between the discretionary and IEP trust? Here the beneficiaries has the right to receive the income or the capital. And the beneficiaries, the right to income or use of an asset under an IEP is known as the life tenant of the trust. The life tenant is said to have a life interest in the trust. They are also known as life tenant because they have a life interest in the trust. They will always have interest in the trust. So the beneficiaries who receive the capital assets in the trust when the life interest comes to an end is known as remainder man. The remainder man is said to have a reversionary interest in the trust assets, as the assets will only revert to the remainder man when the trust comes to an end. It will only go to this person, whoever is having the reversionary interest. So here the main difference is beneficiaries have the right. They have the legal right to receive the income or the asset, unlike the discretionary where the trust will decide. Now, IEP trusts are commonly used in a will. So we'll see where it is most beneficial to use this type of trust. This type of trust are used in a will where one spouse dies and there's a surviving spouse or children. Okay, so the surviving spouse is usually named as the life tenant and is entitled to the income that will be generated by the assets. And they might have the right to live in the family home until death. But the actual capital asset will go to the children. Okay, wife, the surviving spouse will not have access to that capital asset. So here, who is the remainder man? The children. They are the remainder man and they will receive the capital assets on the death of the surviving spouse. This form of trust is a popular arrangement to protect the capital asset for the benefit of children. Let's say this, the surviving spouse remarries. Okay. So here, if through this form of arrangement, capital will be transferred to the children of the first marriage. It will not go to the new partner or it will not go to the new partner's family. So this is the way of protecting. Now let us do one question to know the features of IAP trust. Illustration 2. IIP trust. Here, same arrangement. Settler is the Felicity. Trustess is Michael, Felicity's brother, and Selena, the solicitor. The difference comes from here, this part. Beneficiaries is Malik, the life tenant, and Oliver and Jolly, their son and daughter, who are the remainder men. Okay. Malik is the husband, with the life tenant. So the trust property, house and 350,000 cash. So income will be payable to Malik during his lifetime. Capital will be advanced to the children on the death of Malik. So this is the arrangement of IAP trust. So now let's summarize the trust. The two type of trust that we went through. We started with the definition and the type of trust. So a definition is it's a property transferred by settler to trustee for the benefit of beneficiaries on terms in trust deed. Discretionary trust and IEP trust are the two types of trust. In the discretionary trust, no IEP exists, that is no interest in the trust. The beneficiaries have no legal right to benefit from the income or capital of the trust. Any distribution of the income or capital of the trust is in the hands of the trustees. While on the other hand, IEP trust, IEP exists, beneficiaries have legal right. Okay, that is the life tenant has the legal right to benefit from the income of the trust, and trustees must distribute the life tenant's full entitlement every tax year. No discretionary of trustees. They have to. Whatever the life tenant's entitlement, they have to distribute. Now, we are coming to the income tax and the trust. So we are finished with the definition of trust, types of the trust. Now we are moving on to the tax, impact of taxes. First, we'll finish with the income tax before we move on to the IST and CGT. So, remember, the trust is a separate legal entity for income tax purpose. The body of trustees is a separate taxable person. Trustees are also subject to income tax on the income arising in respect of trust assets each tax year, and they distribute income to the beneficiaries. Remember, an understanding of the way in which the trust income will be taxed is required in your ATX, but calculation of the income tax payable by the trustee will not be asked. It is not examinable. Taxation of the trust income operates like this. The trustees account for the income tax on the receipt of the income by the trust, each taxee under self-assessment. Trustees are taxed at different rates depending on the type of trust. If it's discretionary trust, rates are different. If it's IEP trust, rates are different. This you have to know. And trustees distribute income to the beneficiaries according to the terms of the trust. Now, IEP. All the trust income must be distributed to the life tenant of an IEP trust each tax year. We know this. So therefore, the life tenant is assessed in the tax year of entitlement, not in the year of receipt. The same tax year as the trustees account for the trust income. The same tax year as trustees account for the trust income, life tenant also has to account for it. Now, an income of an IEP trust is received by the beneficiary net of. It's always received net, not gross. Okay. So an income of an IEP trust is received by the beneficiary net of tax. If it is taxed at non-savings, okay, if it's a non-saving income, it will be net of 20% tax. And if it's dividend, it's 8.75. The lowest dividend rates and the lowest non-savings rate, 20 and 8.75. So therefore, you might get a 20% tax credit or 8.75% tax credit to deduct from your income tax liability of the beneficiary. Now, moving on to the discretionary trust. Beneficiary of discretionary trust only receives income at the discretion of the trustee. This we know by the definition. So, here the income distributed from the discretionary trust is assessed on the beneficiary in the tax year of receipt. These are the two differences. If it's IB trust, it's in the tax year of entitlement. If it's discretionary trust, it's in the tax year of receipt that you have to, your income will be assessed to tax. So here, if it's a discretionary trust, this is also received net only, but it's always received net of 45% tax, the highest tax. Okay. Discretionary trust income is always deemed to be received by the beneficiary net of 45% tax, and it's always taxed as non-savings income. Always. So these are the few differences. If it's IEP trust, it could be net of 20% or 8.75%. Here it's net of 45% tax only, and it's always taxed as non-savings income. That means it will be taxed at 20, 40 or 45%. And therefore 45% tax credit is available. You can deduct this from your income tax liability of the beneficiary. Moving on to taxation of beneficiaries. Beneficiaries are taxed on the gross. Remember, when we are taxed, when we put that all the types of income, right? To calculate income tax, where we put non-savings, savings, dividend, property income, investment income, all the types of income, employment income, self-employment. There we put income from trust also. There we always put the gross income, gross trust income. We can't put the net trust income in that table, which will go under non-savings only. So the beneficiaries are taxed on the gross trust income in their personal income tax computation. And they can deduct their income tax liability, the tax credit deducted as source by the trustee. Whatever the tax that was deducted as source by the trustee, you can get a relief on it, tax credit. How? From your income tax liability, you can deduct that 45% or 20 or 8.75% deducted at source. Next. Trustees must give the beneficiaries a certificate each year showing the amount of trust income individual must be taxed on and the associated tax credit. Trustees of discretionary can choose to give income generated from the assets from the beneficiaries who are non-taxpayers. What is the advantage of this? If you are giving an income from the asset to a beneficiary who are non-taxpayer, they can get a repayment of income tax paid by the trustees. They can claim that. So that's an advantage. Because who has the discretionary power? Trustee. They can give it. Now, we have finished with income tax. We are moving on to capital taxes. So ATX requires an understanding of CGT and IGT consequences of three things. Three areas where CGT and IGT consequences will take place. When a settler is gifting assets into the trust and the trustees are gifting that assets out of a trust, into the trust, out of the trust. What are the IHT and CGT consequences of it? So the ATX knowledge of these charges to tax is required, but calculation of CGT and IHT will not be asked. So don't worry, calculation part of in the trust area you will not be asked. Only the knowledge part will be required. Same like income tax. So while the assets are in the trust, there are some further charges to capital taxes. Trustees will be subject to CGT. Why? Because there will be some gain in that trust, inside that trust. So the gains that are arising in respect of managing the trust assets each tax year, it will be taxed at 20 or 28% for 28% for residential property. That means they are always taxed at the higher rate of CGT, not the lower rate, not the 10 and 18%. After deducting an annual exempt amount. See, for trust, annual exempt amount normally is 6,000 for CGT. But for the trust, only half the annual exempt amount is available. That is 3,000. This you have to remember, do not forget. And they may also be liable to pay IHT. If the assets are in the trust, they have to pay IHT as well. Here, in respect of the property held in the trust every 10 years that property is held in the trust, IHT has to be paid every 10 years. This is known as principal charge. And when we are transferring the assets out of the trust, that time also you have to pay IHT. That is known as exit charges. Now, RPT, Relevant Property Trust. For the purpose of your ATX, Relevant Property Trust are defined as all the trust that is created on or after 21st March 2006. Example, discretionary trust and non-qualifying interest in possession trust. Note that an interest in possession trust created on the death of a settler is sometimes referred to as immediate post-death interest or qualifying interest in possession trust. Thankfully, this will not be asked at ATX, so you don't have to worry about it. Now, so this is the summary. IEP trust and discretionary trust. For IEP trust, qualifying IEP trust and non-qualifying IEP trust. That is immediate post all IEP set up on death will not be asked at ATX, but non-qualifying, which is IEP trust, and this will be asked in exam. This is set up during the settler's lifetime. Discretionary. You can set this during the settler's lifetime or on death. Discretionary, there is a choice. Both are relevant property trust, whether it's IB trust or discretionary trust. Now, moving on to gift into the trust. A trust can be created during the settler's lifetime by means of a lifetime gift. And it could be settled, it could be created on death also under the provision of the will or the deed of variation. Deed of variation we have covered in previous lecture, lecture 15. So, there are capital tax consequences of it. Now, so we know when the assets are in the trust, there will be CGT charges. Also, IHT will be there. So the maximum rate of IHT, even while the assets are in the trust, if you are putting the assets into the trust, also there is charge. When the assets are in the trust during the trust time, also there are charges, and when you are putting the asset out of the trust, also there are some taxes. So the maximum rate of IHT that is payable on that principal charge is 6%. This rate you have to know. Once again, calculation of CGT payable and IHT principal charge will not be asked. Gift out of a trust. Okay, when we are gifting the assets out of the trust to a beneficiary, the gift is known as capital distribution, and the property finally passes to the beneficiary. So the legal title passes to the beneficiary. There are capital tax consequences of this because you are making a capital distribution out of the trust. Now, this diagram is very helpful. This is the summary of what I've explained till now. Inheritance tax consequences, CGT consequences of assets into the trust, out of the trust, and while in the trust. So assets put into the trust, relevant property trust during lifetime, all lifetime gift into the trust is relevant property trust. It's a CLT by settler. It's a chargeable lifetime transfer. There is no pet. Anything to the trust, we know through inheritance tax, it is chargeable lifetime transfer. It's not a pet. And on death, This is during lifetime. When it's on death, no special tax consequences. Assets are taxed in the settler's state in the normal way. After tax, assets put into the trust. While it is in the trust, still it's a relevant property trust. There is a principal charge every 10 years, maximum 6%. And assets out of the trust, anytime. Anytime assets are distributed out of the trust, there is an exit charge. Max, again, once again, 6%. Now, capital gain tax consequences. Assets put into the trust. This is for all the trust during lifetime. It is a chargeable disposal. Calculate gain using market value, and gift holdover relief is available on any asset because there is an immediate charge to IHT. So trustees base cost will be equal to the market value less the gift holdover relief. On death, remember, no death, no CGT on death. So not a chargeable disposal. Trustees are said to acquire the asset at probate value. That is the value at the death. While in trust, all trust, chargeable gain on disposal by trustees. If trustees are disposing the asset, it's a chargeable gain. Annual exempt amount is available, that is 3,000. Rate of tax 20, and if it's residential property 28%. Trustees pay out of the trust fund. Out of the trust fund only trustees will pay, and it is assessed under self-assessment rule. Now, assets distributed out of the trust. So, interest ends on death of a life tenant, no CGT, it will not be asked for your ATX. Now, any trust in any other circumstances is a chargeable disposal. You have to work on the chargeable disposal part, not the one which will not be asked in ATX, okay? And again, gift holdover relief on any assets as IST charges there. Now, last part of this lecture, and with this we'll be doing 2 questions and finishing off this lecture. So, tax planning opportunities. By gifting assets into the trust during the lifetime, assets will not form the part of the settler state on death. You see, one advantage. Second, assets that appreciate in value, you can give it in the trust so that increase in value will be outside the settler and the beneficiary's state, hence saving tax. Next, exit charge and the principal charge, which is 6%, is not so significant. So rather it is better to put in the trust rather than not putting in the trust, because the 6% is not so significant. Next, fourth, trustees of a discretionary trust can choose to give income generated from the assets to the beneficiaries who are non-taxpayers so that they can reclaim. They can claim the repayment of income tax that was paid by the trustee. Now let us do 2 questions. Illustration 3, the capital taxes and the trust. So calculate the IST and CGT arising on Habiba's death and show how the state is distributed between the beneficiaries. So Habiba died on 19th May 2023, leaving a widower and 2 children. She made no lifetime gifts. State on her death is valued 422. Under the terms of her will, she requested that discretionary trust must be set up for her children with a cash of 325,000 from her state. Remainder is to go to her husband. So now, if you go by CGT, okay, CGT. First point, no CGT to pay on death. No CGT to pay on death. Next, you have to write this under CGT. Any chargeable assets going into the trust have a base cost equal to the probate value. Okay. Any chargeable assets going into the trust have a base cost You have to talk about base cost equal to the probate value. You have to mention the probate value. This term is very important. And also the base cost. Next, IHT. So with this CTD is done, IHT is the next. You have to label like this. CTD different, IHT is different. Start with the state computation of Habiba. So we start with the state value. What is the state value? It's 422,000. Then we deduct the exempt legacy. Exempt legacy. This calculation of IHT you will know when you do IHT calculation. I've covered in lecture 13, 14, 15. So it is the spouse. Remember the remainder is husband. We still don't know the husband's part. But we can know it. How? They told under the terms 325 from her state will go to the children. So it's just simply 422 minus 325. The remainder that is 97. So 97,000 is to the husband. So 97,000. Now gross chargeable state. Gross chargeable state is 325. From this they will give to the children. Okay. Now this 325 will be covered by nil rate ban. Hence IHT is 0. Now distribution of the state. They also asked you IHT, CGT and distribution of the state. Do not forget. You have to remember all the requirements. Under one question, 2-3 requirements will be there. So remember. So cash to trust, residue to husband. How much is the cash? 325,000 and 97,000. And IHT, this you have to write even if it's 0. IHT to HMRC is 0. This one. Okay. Now let us do illustration 4. Illustration 4, the last question of this lecture. It's about discretionary trust. You have been given 5 parts A, B, C, A to E, which you have to answer. So first one, explain an advantage for Kenza of setting up discretionary trust during her lifetime. This is something theory that you have to write. Next, explain the capital tax consequences resulting from the creation of the discretionary trust on this date. On this date they have created the trust. Explain the tax consequences. Whenever they said tax consequences, they didn't say what type of tax. All the type of taxes, IHT, CGT, income tax, arising during the life of the trust. So first creation of the trust, then life of the trust. Third, D, explain the capital tax consequences of distributing the property out of the trust to Kenza's grandson on this date, that is on 30th November. E, explain the capital tax consequences of creating the trust and the distribution of the to the grandson, assuming the discretionary trust has been set up on her death rather than during lifetime. They just changed the situation. Now, rather than creating it at lifetime, the trust was created during the death of Kenza. Then what would be the consequences of creating the trust and distributing the trust asset to the grandson? Assume the market value of the share in December 24 will be 60,000 for both IHT and CGT purpose. Okay. Now, so first we'll read. Kenza is a wealthy farmer and a landowner has decided to have a discretion for the benefit of his family member. On this date, he put some shares in here Originally bought the shares for 20,000. On this date, market value was 50 for IST, 52 for CGT. No previous lifetime gift. On 30th November, trustees distribute the shares to the grandson, assuming the market value of quoted shares 90 for IST, 95 for CGT. Okay, so first one. Let us do A. So, the solutions with me. Advantages of setting up. One advantage that if the value appreciates, it is outside the Kenza's and her grandson's state. Number one advantage. Two advantages. You always leave a line. Each advantages should be in different paragraph, and it said advantages. So don't write one advantage. At least write 2 to 3. Okay. If the grandson is a non-taxpayer, he will get a repayment of income tax that is paid by the trustee. This is available. So second advantage. Coming to B, when we are creating the trust. So this creation of the trust, out of the trust, that table, this table that I've explained in the slide, IST consequences here, that will help you. So capital tax, inheritance tax separate, CGT separate. Okay. So this is during lifetime. So that's why it's a lifetime gift. It's a CLT. What was the value? 50,000. So based on 50,000 IST value, less exemptions. We don't know exemptions, so we'll just write less exemptions. It's a lifetime IST payable. It's payable by Kenza or trustees by agreement, whoever agrees, because it's a lifetime. Still Kenza is alive, so even she can pay the IST. If Kenza dies within 7 years, there is an additional IST payable on death. And death IST payable by trustees from trust assets. Then the death IST that is payable will be by the trustees that time. Of course, Kenza can't pay after she dies, right? Now, CGT consequences. For CGT, the market value was 50,000, 52,000. So it's a chargeable disposal of asset at full market value of 52 for CGT. You can claim gift holdover relief because immediate charge to IST. Therefore, no CGT payable because you are getting a gift relief also on the full 52,000. So no CGT when assets are put into the trust. The gain is held over. No CGT because the gain is held over against the base cost of the shares acquired by the trustee. So now we'll calculate the chargeable gain. So 52,000 is the market value. Remember what was the cost? You bought it at 20. So 32. So full 32,000 is gift holdover relief. This is the chargeable gain. Now base cost. What would be the base cost? Market value is 52. Gift holdover relief is 32. So this is the base cost. Base cost is always equal to the cost. Coming to C. Tax consequences during the life of the trust. Now you have to include income tax also. So they will be subject to income tax under self-assessment each year. Now inheritance. Because they are in the trust, maximum rate is 6% on the every 10 years. It's a principal charge. Then the first principal charge will be on 6 May 2033. From 2023, 10 count 10 year onward. So 2033. Third, CGT. So the sale will raise capital gain will give subject to CGT. CGT is also under self-assessment each tax year. Now coming to D. Once again, capital tax consequences, but this time they are dying. And it's on the distribution. Sorry, not they are not dying. When we are distributing to the grandson, IST and CGT, there is an exit charge. For IST is based on 90,000, maximum is 6%. Exit charge is 6%. Here, when we are distributing, it's a chargeable disposal. At full market value, gift holdover relief is available. Therefore, no CGT, but you have to acquire the base cost. Let's repetition. So say, market value was 95, cost was 20, 75 is a gift relief. So 75, if you deduct from 95, again is 20. You see at the end, base cost is always 20,000 only. Coming to E, the last one. Now the trust is created on Kenza's death. So capital means inheritance and CGT consequences. when we are creating the trust and when we are distributing to the grandson. When we are creating the trust now, because it's Kenza's death, assets will form part of the Kenza estate. Valuation as 60,000 because for IST and CGT valuation is 60,000. They have given the value. Now, trust established after the state IST has been paid. Then only trust will be established. That means out of after tax assets. CGT, no CGT on death, not a chargeable disposal. Trustees will acquire at probate value of 60,000. Will acquire assets at IST. Now, same consequences as in part D. That means the IHT part will be same. When we are distributing to the grandson, whether the trust was created on death or lifetime, IHT part is same, but for CGT valuation rule is different because they have given the different dates. Probate value is 60,000. Market is 90, so 35. No chargeable gain. Okay, base cost would be equal to the probate value, that is 60,000 only. So gift relief is 35, from 95 we deduct 60,000 is the base cost. Base cost will come to probate value and death. That's the only difference. IHT part will be same. So let us summarize this lecture now. The taxation of trust, income tax and capital taxes. So income tax, trustees are account for income tax on the income generated by the trust assets, each taxee under self-assessment. Beneficiaries receives net income net of tax, IP trust income. If it's IP trust income is 20 or 8.75% net. If it's discretionary trust income is 45% net, and always taxed at non-savings rate. When we are including it in the income tax computation, you have to include the gross income. Deduct the tax credit shown on certificate issued to beneficiary. Then, gifts into the trust while asset in trust out of the trust. So it's relevant property trust during lifetime, IST, always chargeable lifetime transfer by settler, CGT, chargeable disposal at market value, and will deduct the gift holdover relief. On settler's death, IST, assets taxed in the state, trust are set up after you pay IST, and CGT, no CGT on death. When the assets are in the trust, CGT is a capital disposal. You can deduct annual exempt amount of 3,000. It will be charged at 20 or 28%. IST, you have to pay 6% every 10 years on the known as principal charge on the relevant property trust. Then, gift out of the trust, CGT. It's a chargeable disposal and market value. Gift holdover relief is always available. And IST, exit charge maximum 6%. So that's it for this lecture. Thank you for watching, and I shall see you in the next lecture with a different new tax, that is the corporation tax and the company tax. So make sure that you do questions on trust from a revision kit, past paper. It's not much of calculations there to write, and you can get the slides. All you have to is email me and I will send you my slides with the details of the payment, how you have to pay and get the slides. Thank you for watching, and I shall see you in the next lecture.